I was sitting across from an old colleague at a quiet bistro in DC last week, right as the headlines about the strikes in Iran started flashing across his phone. For months, he'd been obsessed with one number: $15.7 billion. That's the record amount China poured into the Gulf last year, a staggering 2,400% surge. He'd lean in, voice lowered, practically vibrating with the conviction that the petrodollar was finally on its deathbed, replaced by a new yuan-backed Middle East. But as the news of the regional supernova broke, something strange happened. He didn't look worried for his Chinese counterparts. He didn't scramble to check his portfolio for losses. Instead, he watched with a sort of clinical, detached fascination as the data started rolling in. Chinese banks weren't just pausing, they were vanishing. Loans were halted, emergency reviews were ordered, and that landmark $2 billion Abu Dhabi bond, the dagger at the heart of the dollar, was unceremoniously declared dead within 48 hours. The mainstream financial press immediately pounced, calling it a humiliating retreat. The narrative was simple. China got scared, realized they couldn't protect their investments without a military, and ran back to Beijing with their tails between their legs. My colleague just smirked, took a slow sip of his espresso, and whispered, "People think they're running away from a fight they lost. They aren't. They're just clearing the room before the building is demolished." It was a chilling thought. You don't pull $15 billion out of a market in a weekend because you're nervous about a dip. You do it because you know the entire foundation is about to be vaporized. While the West celebrates a supposed financial win, they might be missing the most terrifying part of the plan. China isn't retreating from the Middle East. They are systematically clearing the blast radius for a global financial shockwave that makes 2008 look like a rehearsal.
And to really grasp the sheer scale of the operation you're describing, you have to look past the financial press and look directly at the operational mechanics on the ground. I mean, this is absolutely not a sudden reactionary flight of capital.
Right, it's not just numbers on a screen.
Exactly.
Yeah.
Consider the on-the-ground reality for a project manager, let's call him Chen, who spent nearly a decade overseeing these massive infrastructure developments on the outskirts of Riyadh. For years, the rhythm of his operation was just entirely predictable.
Just constant expansion.
A heavy influx of concrete, this ever-growing skyline of cranes, and an uninterrupted massive flow of capital arriving from Beijing to fund these mega projects.
Yeah.
But recently, the directives arriving from headquarters shifted.
They changed the mandate.
Completely. It went from rapid expansion to meticulous consolidation. In the final weeks before this current geopolitical crisis really peaked, his operations consisted not of breaking new ground, but of quietly liquidating assets. Heavy machinery was being systematically repatriated.
Repatriated? Under what pretext?
Under the administrative guise of project completion. And there was no panic in the boardroom. None. It was just a calculated, quiet vacuuming of resources, like a seasoned sailor who watches the barometric pressure drop rather than waiting for the sky to physically turn black. The operation was shuttered, and the capital was pulled back across the border long before the first headlines hit the Western press.
That ground-level perspective completely changes the complexion of the event. I mean, when you observe $15.7 billion being vacuumed out of a region, you're not talking about traders simply liquidating a few stock portfolios.
You're unwinding massive physical commitments.
Exactly. Highly complex financial commitments. This strategic withdrawal of capital demonstrates incredible proactive financial insulation. They are actively safeguarding their economy against potential global oil market disruptions and future instability.
Executing a withdrawal of that magnitude without triggering a localized financial panic requires an extraordinary level of foresight. They effectively built a preemptive financial firebreak.
A firebreak. So the internal logic dictates clearing the decks before a storm that has already been meticulously priced into their macroeconomic models.
Precisely. Categorizing this maneuver as a retreat fundamentally misinterprets the strategy. It's a survivalist's maneuver, and it's executed with remarkable precision. The geopolitical pivot away from the Middle East is driven by a calculated assessment of extreme, imminent uncertainty.
Because the Iran conflict is rattling global markets right now.
It's pushing Brent crude oil sharply higher, and it's threatening massive cascading supply chain disruptions. But the specific overriding vulnerability here is the physical blockade of the Strait of Hormuz.
Right, if that maritime choke point closes.
A closure there poses a direct, unmitigated risk of immediate defaults on major infrastructure projects, not to mention extreme volatility in global energy prices. You simply cannot absorb that level of regional risk.
And what's fascinating is the destination of that repositioned capital. It's not just sitting in cash, it's undergoing a highly strategic pivot.
Right away from the exposed Gulf.
And straight towards Central Asia. If you look at the core fundamentals, Central Asia offers comparable energy capacity to the Middle East. You have massive, proven natural gas reserves in Turkmenistan.
And significant established oil production capabilities in Kazakhstan.
Exactly. But the crucial differentiator is the geography of delivery. Central Asia completely lacks the unavoidable geopolitical vulnerabilities of the Middle East. There is no Strait of Hormuz to blockade when your energy is flowing through secure, direct overland pipelines straight into Western China.
That's the geographic advantage. But the advantages of that Central Asian pivot extend far beyond just energy security. The region boasts superior agricultural resources,
which aligns perfectly with long-term food security objectives.
Furthermore, there is a significantly higher potential for female labor participation compared to traditional Gulf economies.
Meaning a broader workforce.
A broader, dynamic, and highly scalable workforce for localized industrial investments. And simultaneously, you have a secondary migration occurring in the financial sector.
The high net worth capital.
Yes. It is rapidly shifting from highly exposed regional hubs like Dubai toward thoroughly secure, deeply capitalized financial havens.
Places like Singapore and Hong Kong.
Exactly. It's a total repositioning.
All of this proactive insulation points directly to the system reset scenario that is currently being modeled. The trigger event that necessitates this absolute level of financial fireproofing is a severe escalation.
A push to the absolute brink.
We are looking at a scenario where Iran categorizes all oil facilities in the Middle East as legitimate military targets. This involves a coordinated, highly destructive attack on 50 key production and port facilities spanning Saudi Arabia, the United Arab Emirates, Kuwait, and Iraq.
You're talking about assets like the Ghawar field.
An absolute behemoth. That field alone accounts for nearly 5% of global daily oil production, along with critical export terminals like Ras Tanura.
The immediate physical consequence of a coordinated strike of that magnitude is just staggering. Between 20% to 30% of the total global oil supply vanishes instantly.
To accurately contextualize what that means for global infrastructure, you just have to look at the United States Strategic Petroleum Reserve. It holds roughly 360 million barrels of oil.
Right, and at a sudden global supply loss of 20 million barrels per day.
That entire reserve would be completely drained in just 18 days. It renders the strategic reserve a mere temporary measure over a catastrophic structural wound.
It's a Band-Aid.
And the physical shortage of oil is only the catalyst. It is the first domino in a much larger systemic collapse that fractures along 4 distinct global fault lines.
Let's examine those fault lines systematically. Because the oil is just the physical trigger. The real damage is financial.
Starting with fault line 1, the sovereign fire sale. Middle Eastern sovereign wealth funds control over $2 trillion in assets globally.
If their domestic infrastructure is suddenly destroyed.
And their primary oil-driven revenue stream instantly drops to zero, they are going to require astronomical amounts of cash immediately. They need liquidity simply for state survival, to rebuild vital infrastructure, and to maintain domestic stability.
And how do they get that liquidity?
This triggers a panicked, limitless fire sale of their international holdings. Specifically, they would be forced to liquidate their massive holdings in the $27 trillion U.S. Treasury market to acquire dollars rapidly.
Dumping that volume of sovereign debt onto the market simultaneously creates an unprecedented liquidity crisis. I mean, the bond market operates on supply and demand.
Right.
When massive entities dump trillions in treasury bonds, the price of those bonds crashes. And because bond yields move inversely to bond prices, this sends global interest rates skyrocketing overnight.
It instantly freezes global credit markets.
Completely. Borrowing costs for everything from corporate debt to consumer mortgages would surge uncontrollably.
Which leads directly into fault line 2, a paralyzed Federal Reserve. Because at the same time, a catastrophic drop in global oil supply pushes prices to $200 or even $300 a barrel.
Generating brutal stagflation.
A devastating macroeconomic combination of stagnant economic growth and runaway inflation. Central banks, particularly the Federal Reserve, face an impossible dilemma here.
If they raise interest rates to fight the rampant inflation caused by $300 oil, they will absolutely crush an already weakened global economy.
Accelerating a deep depression.
But conversely, if they cut rates to stimulate the collapsing economy,
they risk igniting uncontrollable hyperinflation.
Furthermore, the Federal Reserve would be forced to intervene in the sovereign fire sale you mentioned. To prevent the complete collapse of the U.S. Treasury market, the Fed would have to print trillions of newly created dollars to absorb the crashing bonds that the Middle Eastern funds are dumping.
And injecting that much raw liquidity into a stagflationary environment effectively destroys the long-term credibility of the US dollar as a stable store of value.
It signals to the world that the currency is being infinitely diluted to cover systemic structural failures.
That loss of credibility bleeds right into fault line 3, where the institutional damage becomes terminal. The derivatives black hole.
This is the quiet killer in the system.
The global energy derivatives market is massively leveraged. Financial institutions, airlines, manufacturers, massive trading houses, they all use these derivatives to hedge against price volatility or to speculate on future market movements.
It operates like an incredibly complex, highly leveraged insurance market.
Right, so an instantaneous, unprecedented jump in oil prices to $300 a barrel triggers catastrophic margin calls for any entity caught holding a contract betting on lower or even stable prices.
A margin call requires the trader to instantly provide additional capital to cover their massive sudden losses.
But because the price spike is so extreme, giant trading houses would be completely unable to meet these calls.
They'd be forced into a total immediate liquidation of all their assets across all markets just to generate cash,
triggering a cascading domino effect. The failure of the trading houses takes down the core Western lenders who provided them with the leverage in the first place.
It sparks a systemic Lehman Brothers-style banking crisis, but unfolding on a timeline measured in hours, not weeks.
The final blow to the system is fault line 4, the global dollar famine. Because the global oil trade is fundamentally priced and settled in US dollars, a tripling of the physical oil price requires 3 times as many dollars just to purchase the exact same, now diminished supply of energy.
This instantaneous, desperate demand triggers a massive global dollar shortage.
The value of the dollar violently spikes relative to all other global currencies.
The consequences for the developing world are immediate and devastating. Debt-heavy nations would experience rapid currency collapse. Their local currencies become practically worthless against the surging dollar.
So they can no longer afford the dollars required to service their dollar-denominated sovereign debt,
leading to a massive wave of sovereign defaults across the global south. And these defaults would then flow backward, further infecting and degrading the balance sheets of the Western banking institutions that hold this emerging market debt.
The interconnectedness of these 4 fault lines makes the situation intensely precarious. However, you have to realize the U.S. financial system possesses highly aggressive, centralized mechanisms to manage this exact scenario. Let's look at the U.S. defensive playbook,
which essentially relies on weaponizing the financial architecture itself.
The response to the sovereign fire sale involves invoking the International Emergency Economic Powers Act, or IEEPA. This is a powerful statutory mechanism utilized historically during the 1979 hostage crisis.
With a single executive order, the administration can simply freeze foreign-held assets, preemptively neutralizing the Middle Eastern sell-off before it can crash the Treasury market.
Concurrently, regulatory bodies like the Securities and Exchange Commission and the Treasury Department would step in and physically halt trading across all U.S. bond and equity markets.
They pull the plug on the exchanges to prevent a total routing of asset prices.
This shifts the operational mandate of the Federal Reserve into a wartime command protocol. Suspending standard economic mandates, the Federal Reserve would deploy hyper-targeted, ring-fence liquidity directly to critical financial institutions.
Utilizing Section 13(3) of the Federal Reserve Act, it allows for broad-based emergency lending facilities in unusual and exigent circumstances.
And to combat the massive inflationary surge caused by the oil shock and those targeted liquidity injections, the Defense Production Act would be heavily expanded,
effectively moving the U.S. into a command economy.
The act would enforce strict energy rationing and mandatory price controls across the domestic economy. Inflation, in this extreme context, is no longer treated as an economic variable to be managed by adjusting interest rates.
It's treated as a wartime necessity that requires direct physical market intervention and rationing.
We would also see brutal exchange-level interventions to prevent the derivatives black hole from swallowing the banking sector. Western regulators are entirely prepared to override standard contract law to save the structural integrity of the system.
We observed a clear precedent for this during the 2022 London Metal Exchange nickel crisis.
Right, when the price of nickel surged uncontrollably,
threatening a massive clearinghouse failure. The exchange simply halted trading and forcibly canceled thousands of trades, settling outstanding contracts at pre-crisis levels.
So global commodity exchanges would execute this exact maneuver for energy derivatives.
Absolutely. They will preserve systemic structural integrity by force, entirely prioritizing the survival of the clearinghouses over any theoretical concerns regarding moral hazard or the sanctity of the financial contract.
But the most profound geopolitical maneuver involves actively weaponizing the global dollar famine we talked about. The massive spike in the value of the dollar acts as a powerful defensive shield.
It effectively lowers the cost of imports for the U.S. domestic economy relative to the rest of the world,
Exporting the inflation outward. And from this fortified economic stance, the ultimate geopolitical weapon is deployed: unlimited central bank liquidity swap lines.
These financial pipelines provide vital, limitless dollar liquidity, but they are opened exclusively to critical, fully aligned allies.
Such as the European Central Bank, the Bank of Japan, and the Bank of England.
The flip side of that weaponization is severe. It is highly coercive. Non-aligned nations are deliberately starved of access to these dollars.
Engineering a geopolitical compliance mechanism. Dollar lifelines are exchanged only for absolute, unwavering strategic alignment with U.S. geopolitical objectives.
Nations must either align completely with the prescribed global posture, or their domestic economies collapse under the crushing weight of the engineered dollar famine. It's a stark demonstration of how the architecture of the current system can be converted instantly into a geopolitical cudgel.
And this defensive playbook brings us to a critical realization regarding China's proactive measures. Consider the actions of a senior financial officer at a major state-owned enterprise who has been tasked with a comprehensive ledger migration.
Operating under the firm premise that U.S. dollar dominance is a critical vulnerability.
Especially given the weaponized defensive playbook we just outlined. This officer began executing a fundamental shift in the rules of global trade. In new, massive contracts for energy and infrastructure, the dollar was systematically and quietly swapped for the yuan.
The strategic rationale communicated to international trading counterparts was one of absolute economic sovereignty. Tethering global trade to the yuan acts as vital structural insurance against a Western banking system that can and will be weaponized or abruptly collapsed to serve domestic U.S. interests.
You see how China's calculated capital repositioning and promotion of yuan-denominated assets aim to strengthen financial sovereignty and reshape global energy trade dynamics amidst regional tensions. It is a masterful display of long-term structural planning.
It transcends simple currency exchange to save on transaction fees. It is the methodical construction of a sovereign arc.
A sovereign arc.
A deliberate, highly resourced attempt to entirely decouple national economic life support from an untrusted, highly volatile system. The goal is to ensure that when the global derivatives black hole opens and when the dollar famine is inevitably weaponized, the domestic Chinese economy and its aligned trading partners remain securely insulated within a parallel, fully functional financial ecosystem.
To understand the viability and the operational reality of the sovereign arc, you must examine the mechanics of financial independence. Specifically, comparing the legacy SWIFT network to the cross-border interbank payment system known as CIPS.
To visualize the difference, think of the existing SWIFT system as a highly secure text messaging service for banks.
Right, it doesn't actually move the money.
No. When a bank in Europe wants to send money to a bank in Asia, SWIFT simply sends a message saying the transfer is approved. The actual money then has to move separately through a complex network of correspondent banks.
A process that is deeply entwined with the U.S. dollar and Western financial institutions.
This structural reality makes SWIFT highly susceptible to political influence, data surveillance, and the immediate enforcement of unilateral sanctions. It is a fundamental choke point.
In stark contrast, you have CIPS, which was strategically launched in 2015. CIPS integrates both the messaging protocol and the direct settlement functions.
It offers real-time gross settlements specifically for yuan transactions. Returning to your analogy, CIPS does not just send the text message, it hands over the digital cash instantly, in real time, within its own closed-loop system.
It utilizes the highly structured ISO 2022 messaging standard,
which significantly enhances data richness, transparency, and operational efficiency. CIPS has rapidly expanded to include over 1,661 participants across more than 100 countries.
It is heavily and deliberately utilized within the vast framework of the Belt and Road Initiative. The strategic promotion of yuan-denominated assets through CIPS aims to completely bypass the need for any dollar conversions,
effectively shielding participating nations from U.S. financial coercion or sudden asset freezes.
And this robust digital infrastructure is complemented by a highly sophisticated physical commodities and currency strategy. The establishment of dedicated renminbi trading platforms, such as the Shanghai Oil and Gas Exchange, alongside the creation of renminbi-denominated commodity indices, actively reshapes global energy trade dynamics.
By securing massive international agreements to settle natural gas, oil, and gold transactions directly in yuan, a robust, functional, and highly liquid alternative to the legacy petrodollar architecture is established.
It deeply anchors the currency to tangible, critical global commodities rather than just debt instruments.
Which perfectly sets the stage for the culmination of this strategy. Imagine a strategist in a high-rise in Shanghai, carefully observing the sovereign fire sale simulations running on their terminals.
The internal focus within these closed, highly informed circles is not on the immediate chaotic disruption unfolding in the Middle East.
No, their operational focus is entirely on the day after. A sudden 20% drop in global oil supply is not viewed with panic because massive strategic petroleum reserves, comprehensive long-term supply contracts, and secure alternative overland trade routes have already been firmly established and secured well in advance.
The foresight behind China's regional financial maneuvers highlights a long-term strategy to enhance economic resilience and position itself advantageously within a potential new multipolar monetary order.
The anticipated geopolitical strike in the Middle East is modeled internally not as an apocalyptic end state, but as a necessary, inevitable system reset.
By proactively withdrawing vulnerable capital from the Middle East beforehand, the macroeconomic architecture is perfectly positioned. China emerges as the only major global economic power possessing a clean, highly liquid, and fully insulated balance sheet.
This occurs precisely while the rest of the legacy global economy drowns in skyrocketing interest rates, paralyzed central banking mechanisms, and cascading sovereign debt crises.
It is a narrative of absolute long-term resilience and profound structural awareness.
They are operating on the fundamental, data-driven assumption that the current unipolar global order is already obsolete, structurally unsound, and destined for a chaotic, unavoidable restructuring.
The withdrawal of capital and the meticulous construction of financial insulation are a strategic opening. It is designed to secure an absolute, unassailable economic advantage within the new multipolar reality that emerges the day after the global financial reset.
Achieving this transition requires expertly navigating complex macroeconomic realities, specifically the concept known as the trilemma.
In international economics, the trilemma states that a country must balance three goals: capital mobility, exchange rate stability, and independent monetary policy.
Historically, authorities maintain strict, unyielding control over the exchange rate and tightly restricted capital flows. However, there is a carefully calculated policy shift currently underway.
They are strategically prioritizing the liberalization of capital mobility and the rigorous maintenance of an independent monetary policy.
This signifies a mature, highly confident willingness to accept natural exchange rate fluctuations as a necessary structural step toward the deep, permanent internationalization of the currency.
Because a globally utilized reserve currency must be allowed to float and accurately reflect international market dynamics, and they're building the framework to support exactly that.
The technological spearhead of this entire overarching strategy is the digital leap, the deployment of the ECNY, and the establishment of blockchain interoperability.
The development of this central bank digital currency represents a quantum leap in absolute monetary sovereignty. It is important to distinguish this technology. It is 100% backed sovereign money.
This makes it fundamentally distinct from the extreme speculative volatility of private cryptocurrencies or the localized operational risk of privately held digital payment platforms.
It is the highly secure digital embodiment of state financial stability programmed for international utility. The underlying technology of the ECNY is revolutionary for the future of international trade.
It utilizes advanced, highly secure blockchain programming, resilient peer-to-peer networks, and real-time execution protocols.
This technological architecture allows it to entirely bypass traditional proxy banking, slow correspondent banking relationships, and the legacy SWIFT network completely.
Furthermore, multilateral initiatives like the Enbridge project are currently establishing interoperable digital ledgers across multiple central banks globally.
This enables instantaneous, frictionless, and entirely secure cross-border wholesale transactions directly between sovereign entities.
This advanced digital infrastructure creates a technologically superior, politically neutral payment ecosystem. It cements a long-term, highly resourced strategy to completely reshape global finance without any reliance whatsoever on legacy Western intermediaries.
It is a future-proof, highly resilient architecture designed to handle the massive volume of global international trade securely and efficiently, operating entirely outside the blast radius of the legacy dollar system.
The data and the massive systemic movements observed over recent months point to an undeniable structural transition occurring right before our eyes.
The quiet withdrawal of $15.7 billion from the Gulf is not an isolated reactionary event. It is the physical, undeniable manifestation of a profound macroeconomic realignment. As global fault lines are carefully mapped and vast defensive fire breaks are established, the fundamental architecture of international trade is being rewritten in real time. The construction of parallel, highly secure payment systems, the strategic hoarding of absolute sovereign resilience, and the deployment of advanced digital currency networks indicate that the foundation for the next century of global finance is being laid right now. You are left observing a world where true geopolitical dominance is no longer determined by who commands the largest military, but by who controls the ledgers and the infrastructure when the old system inevitably forces a reset.